All right, guys, let's start. Okay. So now we are doing your chapter number 2 in equity, right? So chapter number 2 is about your security market indexes. Some people call it indices also, right? First, we'll talk about module 1, which is your index weighing methods. Then we'll talk about your module 2, which is uses and types of indices, right? Indexes, right? See, ultimately, indexes plays a lot of important role in equity investments, right? Uh, if you think about equity investment, there is a big push towards a passive investment. And if people have to do passive investment, people like to do investments in your security market indexes, right? So that's the whole idea, right? So in this particular path, right? So what we will do is that we try to understand one thing, right? One thing is that how do we measure the market, right? So you cannot invest, benchmark, or evaluate performance unless you have a reference point. And that reference point is called your index, right? So that's what we'll try to do. And that's the whole chapter in two modules, right? So let's get started, guys. Let's dig deeper. Now, first one module, module number 1, which is index weighing methods. We'll try to understand it. We'll try to cover the topic defining a security market index, what exactly is an index, your basic kind of definition, then index value and return calculation, how index value and returns are calculated, what is the math behind it, index construction, choices and issues, how indexes are constructed, design decisions. Then you do the comparison of index weighing method, which is critical for exams. Then you do the price weighing, which is kind of price weighted index. Then you do the market cap weighted index, most important. Then you do the equal weighted index, right? Think of it as first understand the what, then understand the how, finally understand the differences, right? That's what we try to do. Okay. Then next part is defining a security market index, right? If we uh, kind of cover it now, right? So please listen to me carefully. There's a lot of theory, right? So the idea when we're trying to define a security market index is that security market index is a measure of performance of an asset class, which can be equities, which can be bonds, an asset class uh, can be in different countries, a market which can be India, US, a segment which can be large cap or technology. The key insight here is that an index is not a single asset, it's a portfolio of securities, right? When you talk about your index value, right? Index value, when you talk about a number representing the market at a point in time based on prices of underlying securities. Example, Nifty value today, it ended at around 24,200. Think where is the market right now? Then we talk about your index return, right? Percentage change in index value, return is equal to new value minus old value divided by old value. And you think about it as how much the market grew, right? So that's a security market index. Then we go into your practice question. So a security market index represents what, right? ABC. Risk of security market? No, not at all, right? Security market as a whole, not exactly. Market segment, security market segment or asset class. Yes, C is the answer, right? See, index is not equal to only risk, right? That eliminates our option A. Index is not always entire market, that eliminates B also. Index is a representation of any defined segment, right? This is a definition-based question, very common in CFA, right? So once we have done this, we move ahead. The next part here is index value and return calculation. When you look at index value and return calculation, this is very important for your exams. There are two types of your index returns, right? One is a price return, another is a total return. Price return only considers your price changes, ignores the dividends. Example, stock goes up from 100 to 110, return is 10%, right? Total return includes your price changes, dividends, your income as well. Example, price grows from 100 to 110, dividend is 2, total return is equal to 112. Total return is equal to 12% because amount is 112, right? The key idea here is the total return is real return for investors. The special case here is that if asset is an index produce interest cash flow such as dividends, interest payment, the total return will be greater than the price return, right? Which we know. Okay. Now, total return greater than price return is a concept you will need to keep in mind, right? So compounding your returns, right? Very, very important. If we have returns are calculated for each period, then they can be compounded together to arrive at the return for the measurement period, such using the geometric relationship. Please understand this formula. Return of your portfolio is equal to 1 plus R1 into 1 plus R2 into 1 plus R3 into 1 plus RSK minus 1, where RP is the portfolio return during the measurement period, K is the total number of periods, RSK is the portfolio return during the sub period K, and then you multiply it, you get the answer, right? For example, make it simpler, right? Let's try to make it simpler, which is the example given here. There are two periods, 0.50, 1.04%, 1.005, add it, 1.0104, you get it 1.55. Not 1.54 addition, it's the compounding which works, that's why it's 1.55. There's a check whether you know this concept or not, right? If index start at 0, it gives you 101.55, right? Always use geometric compounding, not your arithmetic. That is very, very important to understand. Then we get into your index construction, choices and uses. This is where index provides, or index providers make your decisions. You have target market, security selection, weighing method, rebalancing, re-examination, right? Target market, what are we tracking? Broad, all US stocks, narrow, right? Small cap value stocks, right? This defines your investment universe. Then we have security selection, which stocks to include, it comes here. All stocks or a sample representative, trade-off is accuracy versus practicality. Then we have the weighing method, most critical decisions, price weighted, market cap weighted, equal weighted. This determines how much impact each stock has. Then we have rebalancing, how often weights are adjusted, monthly, quarterly, annually. Without rebalancing, index drifts from your original design. Then we have reconstitution, re-examination, when to change your constituents, add or remove stocks. Example, company exits an index, it is replaced, right? So that's what we need to understand. Very theoretical, very easy, guys. Once we have done that, we go to practice question number 2. 1 month after inception, the price return version and total return version of a single index consists of identical security and weights will be equal if market prices have not changed. No, right? Not in this case, right? Capital gains are offset by capital losses. No, not exactly. Securities do not pay dividend interest, right? So if income is 0, right? Both returns are kind of same, right? Because price return versus total return, basically the difference comes out in income, right? So golden rule is that total return is equal to price return plus income, right? So total return equal to price return. That's your income. Income basically is dividends and cash flows, right? So income is equal to 0, right? To meet, kind of make TR equal to PR, right? So keep that in mind. Please understand total return includes income. Income can be dividends, interest. Price return kind of ignores it. So if no dividends, no interest, then both indexes move identically. The takeaways, very important for exam, index is equal to portfolio representation, 2 returns, price return, total return, more realistic, always use geometric compounding. Index construction depends on market definition, your selection, your weighing, your rebalancing. If no income, price return is equal to total return. Okay, so keep that in mind very, very critically. Right, going on. Let me move to the next question. Next question is your question number 3. The value of a price return index and a total index consist of identical equal weighted dividend paying equities. Will be equal when, right? See, they will be equal only at inception. Why only at inception? Because see, the core concept is that difference between the two is dividends or the income. Price return ignores dividend. Total return includes your dividend. So key insight is at inception, no time has passed, so no dividends received yet. So both start at the same base value, so only at inception. Why not others? Because if you look at your rebalancing, right? So rebalancing just adjusts your weight, does not remove dividend impact. If you look at reconstitution, changes your stock, still doesn't eliminate your dividend. Only situation there matches when no income has accumulated. So the point here is exactly at inception, both indexes start equal. After that, total return is greater than price return if dividend exists. Very, very important. Okay. So this is done. Then we go into your practice question number 4. Security and market indexes are what? right? Constructed and changed like a portfolio of securities? Yes, true, because security market indexes has weights, right? Your has rebalancing, has your selection rules, right? When you look at option B, simple interchangeable tools for measuring the returns of different asset classes. No, it's not an interchangeable tool. Equity index is not equal to bond index. Different construction, different results. Uh, Security market index are valued on a regular basis using the actual market price of the constant securities. Yes, it uses your market price, so that is good. But definition is much broader, right? I'm not saying this is totally wrong. They do the thing, but which is more important is this one, constructed and managed like a portfolio security, right? So they're valued, uh, using prices, but please keep in mind, right? The more accurate is this one. Uh, Index is equal to managed your portfolio, not just a number. Uh, Also keep in mind that it reinforces the concept that index behave like a portfolio manager's construct. It should keep in mind, right? Okay, then we get into next part, which is your practice question number 5. When creating a security market index provider must first determine what? Target market, appropriate weighing method, or number of constant securities, right? So you need to think logically before anything. You must decide what you are kind of tracking. So the most important is that you need to understand your target market first, right? So that is very, very important. Then it comes the security selection, then comes the weighing method, then comes the rebalancing, right? So first thing, right? Because the question is asking first, you need to understand target, right? First, keep the target market. That's the first thing. The second is security selection. Third is weighing method. Fourth is rebalancing, right? So first one is your target market, right? Remember that. Okay. So please keep that in mind. Target market defines your investment universe. Without defining a market, nothing else makes sense. Now we move to the next part, which is calculation-based question. Analyst gathers the following information for an equal weighted index comprised of assets Abel, Baker, and Charlie. ABC equal weighted index is given, right? So what we understand is Abel is beginning price 10, end price 12, 20, 19, 30, 30, right? And dividend is 0.75, 1, and 2. So this is the price return. You kind of ignore the dividends, right? So step one is you need to calculate individual returns, right? Individual returns, so which will be for Abel, 12 minus 10 divided by 10, which is 20%. For Baker, which is 19 minus 20 divided by 20 minus 5%. Charlie, 30 minus 30 divided by 30, 0%. Right, so equal weighted index, what do we do? Right, give the weight equally to each one of them. Right, so equal index is the simple average of the return, right? Equal weights, right? Equal weighted index, simple average, right? So 20 minus 5 plus 0 divided by 3, which is 15 by 3, gives me 5. Simple average, right? Okay, keep this in mind, right? Price return is equal to weighted average equal weights here, right? Please remember, price return is basically your weighted average. But why did we take it average here? Because weighted average means we could have done this also, right? 20 into 1 by 3 minus 5 into 1 by 3, 0 into 1 by 3, and then found the value. But again, this was same now, 1 by 3, 20 minus 5 plus 0, right? So it is like 15 by 3 is equal to 5. Okay, same data, uh, right? The next question is exactly same data, but we are asked your total return now. Same data, we are asked total return. total return of the index, what happens here is that now we'll include a dividend also. So when we include the dividend, that calculation we should be able to do. So to save our time, we'll go to the calculation. So you can see here, same thing, 12 minus 10 plus 0.75, right? 90 minus 20 plus 1, 30 minus 30 plus 2, right? So now here 27.50, 6.7, right? Equal weighted, same thing, get 11.4, right? So again, the concept is same, right? I'm not saying concept is difficult, right? But you have to add the total return, you have to add the dividend, right? So this is to be done. Then we move to your question number 8, right? The question number 8, we are looking at after both your price return and total return, we have again got a question of price return, which is basically analysts gather the following information with price weighted index, ABCDF, GHI, and price return of the index has to be calculated, right? So when we try to calculate the price return, right? So ABC 25, 27, 35, 25, 15, 16, right? And when we are trying to calculate the price, right? For each we have to calculate, right? And then this question doesn't exactly say, right, that it is a equal weighted thing, right? It's a price weighted index, right? It doesn't actually say that it's a equal weighted thing. So how do we do it, right? So what will we do here? If we go to see here, what is done here? The price return of the price weighted index is the percentage in the price of index, right? So what is being done here? You add the full thing. You add the full thing. Ultimately, 75 and you're 68. Right, so 68 minus 75 divided by 75 is equal to minus 9.3%, right? So higher price stocks have more influence, very important to understand. Also, it is very important to understand that you just sum the prices, compute the percentage change uh, for your price return of the price weighted index, right? So simple. Now, there is another question in this chapter, right? This question number now. Right? Here we have analysts gather the following information for a market cap weighted index. That was your, you need to know the small differences, right? The previous question was price return for the price weighted index, right? So simply we added up and found out. Here we are looking for price return for a market cap index, price return for the market cap index, right? So what is the difference here? See, when you look at your market cap index, right? So you have to understand the multiplication with your, you have to find the market cap, right? Which is this shares multiplied by your share price, right? So that is what you need to find out, right? So you have to find the beginning market value. You have to find the ending market value. Beginning market value and ending market value. Ending market value, how do you find out? Ending market value, you find out beginning, you multiply this. Ending, you multiply this with this, right? And right, beginning with ending, right? So then we calculate, right? So basically, idea here is that it's a market cap thing. So it will not come out just by adding, right? You have to multiply and then get the value, right? So beginning market value, just found out multiplication, this value, ending market value, this value. So 48 to 50,000 minus your 53, 750,000 divided by 53, 750,000, right? So again, small things. Figure out how these are calculated. If you calculate this, you saw B is the correct answer, right? Then we get into next question. Next question is, when you get into next question, which is question number 10. Analyst gives the following information for a market cap weighted index, total return. Total return, again, you do the same thing, but you add the dividend also, right? So same logic, but don't forget to multiply stocks with dividend because dividend is per stock, right? So total dividend also, right? So this is beginning market value, this is ending market value, total dividend also, right? Now total dividend will go where, right? Total dividend will go in the total dividend will go where? Beginning market value or ending market value? That will go in the what do you say? Where it will go, right? So total value at the beginning is given this, right? Ending value is a combination of this, right? So you have 48, 250 plus your 2625 minus beginning value 53, 750 divided by your 53, 750, right? That is your total return as this, right? So ending value plus dividend will be the value, right? Because dividend is coming later, right? So that is, keep that in mind, right? So again, this you have to do, guys. Okay, so when we carried out the price return in the previous question, it was minus 10.23. When we carried out the market or total return, right? You added the dividend, it is minus 5.35. So dividend kind of reduces the losses. Then we understand from the previous question is that income kind of questions your dividend, right? So we need to understand. When creating a security market index, the target market determines the investment universe. Your is usually a broad defined asset class, determines the number of securities to be included in the index. Security market index, the target market determines the your investment universe, right? Why? Because target market define what can be included, right? So universe always come first, right? Remember that. Okay, small things you have to read carefully. Then we go to your practice question number 12. An analyst gathers the following data for the price weighted index, right? You have security ABC, beginning of period 20, 50, 26, share outstanding, end of period, shares are given again. The price return for the index. Now we are asked price return for the index. Beginning price is given 20, ending 22, 50, 48, 26, 30. You have to calculate the return. How will you calculate the return? Here outstanding are same. In this case, also this. End of period, also this. What do we do in the price return? Share outstanding given, but kind of you can ignore it, right? You don't need to bother too much because the price weighted index depends only on the prices, right? So what do we do here? The important part is that when we take the price weighted kind of thing, right? You focus only on the prices, right? So how do we calculate here? Any logic? What do we do here? Direct. The sum of prices at the beginning of period was 96. Sum of price in the period was 100. 100 by 96 minus 1, right? That's straightforward, right? 100 by 96 minus 1. So easy, but so confusing because, and that's why I went directly to the answer, right? A lot of people, when trying to price return, they'll say multiply, etc. Ignore that, right? 20, 50, 26, right? So this is beginning value, this is ending value, 48 and 100. So it is ending minus your beginning divided by beginning. So that's straightforward, right? 100 by 96 minus 1. Okay, very straightforward, very simple. Then we get into your, what do you say, index weighing methods. Index weighing methods, very important to understand is that all method you need to know are already been touched. Your price weighted, your equal weighted, your market cap weighted, your float adjusted, your fundamental weighted, that we need to understand, right? And think of this as how do we assign your weights to your stocks, right? So when it comes to your price weighted, please remember very clearly, calculation is arithmetic average of constant stock price divided or adjusted for stock splits and composition changes to maintain index continuity. Simple computation, you have your arithmetic average here, right? Arithmetic average here. Disadvantages, higher price stocks have disproportionate impact on index value, stock split, repurchase, or stock dividend changes securities weight going forward, right? When you look at replication, portfolio is equal number of share in each constant matches the price return, excluding your dividends. Example, Dow Jones Industrial average with 30 US stocks, Nikkei Dow Jones average 2225 Tokyo Stock Exchange stocks, right? Simple and straightforward, right? Then we get into your equal weighted, right? Again, arithmetic average return of index stock matched by portfolio with equal dollar amount in each stock. And disadvantage simplicity, disadvantage periodic rebalancing, overweight smaller capitalization firms, underweight large relative value proportion. Example, value line, composite average, financial time coordination index, market cap, weight index, calculation weight based on each stock market cap, portfolio where each equity position line matches the proportion of total market cap. Advantages, represent changes in aggregate investor wealth, no adjustment needed for stock split or stock dividend. Disadvantage, potential overweight, overvalue stock, and underweight, undervalue stock, creating momentum like strategy, Standard and Poor's, index composite, right? And then we move ahead. Your float adjusted, market cap, right? Market float definition, total value of shares actually available to investing public, excluding shares held by controlling stockholders, corporate or governments, foreign buyers. Calculation similar to market cap weighted, but use only shares available, right? Okay. To investors rather than total share outstanding. Impact, firm with large controlling shareholder position receive less weight than in adjusted market index. Fundamental weighted index, firm fundamentals such as your earnings, dividend or cash flow, etc. Advantages, avoid market cap weighted bias towards overvalued firms. Create value tilt by overweighing firms with high value metrics. And characteristics with weights unaffected by share price directly, though related over long term. Okay. So remember that, right? So these are all very simple, guys. You are in one case you're weighing the fundamental, in one case you're float adjusted market cap, where you're similar to market cap but use only shares available to investors. Then you look at normal market cap, normal equal weighted, normal price weighted. So very straightforward, very simple, right? Then we go into your comparison of index weighing methods, right? Market cap weighing uses weights based on price multiplied by shares outstanding, more closely representing changes in aggregate investor wealth. Then we have market float. Market float represents shares actually available to the public, excluding those held by controlling shareholders. Free float further excludes share available to foreign investors. Float adjusted market cap being used the proportionate value of shares available to investors related to the total available market share. Disadvantage of value weighing is that the overvalued stocks are given higher weights, similar to momentum strategy, while undervalued are given underweight. Fundamental uses metrics like so and so, avoiding the price bias or market cap and creating a value tilt. So you need to know, right? So this 1, 2, 3, it's kind of summary, right? It's kind of summary of point, comparison of different index method, where to use, what to use. That will give you an idea and what are the problems with that. Then we get into your price weighing. So price weighing, when we look at this thing, right? So again, see, if you are getting confused, right? If you are somebody who thinks, sir, I am feeling little overwhelmed, right, by all these things, and I want to know much more, right? So please understand clearly that when we consider the price weighted index, right, weight is equal to stock price, right? So not your company size, not your share. Advantage is very easy to calculate, very simple. Disadvantage, very, very important, comes in exam. High price stocks kind of dominate. Stock splits kind of distort your weight, not economically meaningful. When you try to replicate by equal number of share of each stock, example, Dow Jones Industrial Average, Nikkei. So a $3,000 stock impacts more than a 300 stock, even if the 300 stock is a bigger company, right? Then we look at your equal weighted index. Every stock has same weight. Advantage is simple, diversified exposure. Disadvantage requires frequent rebalancing, high transaction costs, overweight small cap stock. Example is value line index and your FT, financial time equal weight variance, right? This is basically a small capital strategy disguised as your neutral investing, right? So remember that. Then we have market cap weighted index, right? Key idea is bigger companies, bigger weight. Advantages reflects real investor wealth. No rebalancing needed. Auto adjust, more realistic. Disadvantages, overweight, expensive stock, momentum bias. The insight here is if a stock rises, weight increases, you own more of it. This is momentum embedded. Then you have the float adjusted market cap. The key difference is use only tradable shares, excludes your promoter, government holding strategic stakes. Impact is more realistic for investors, lower weight for tightly held companies. This is what accurate index funds track. Then you look at your fundamental weighted stocks, weights based on earnings, cash flow, and dividend. Advantages is avoids overvaluation bias, value tilt. Characteristics is price does not directly drive your weight. This is your systematic value investing strategy. Now, comparison, which is this one, very, very important. Market cap reflects your wealth momentum, right? It's not your momentum bias, right? So, when you look at market cap, you use weight based on price multiplied by shares, right? So that is what float adjusted, which is your realistic investable universe. Price weighted, the problems are that it is kind of what you say arbitrarily distorted by price, right? And again, fundamental value tilt more stable, right? So keep that in mind. Okay. Then as we go ahead, right? Then we go into your price weighing. Price weighing, when you look at methodology, price weighing index sums the market price of each stock and divides by the number of stocks in the index. Formula is given here. Sum of stock price divided by number of stocks in index is splits. Uh, Please understand that there are adjustments in your denominator, which is divisor, used when stock splits, your mergers, or opposite changes. If stock split, price kind of halves. Without divisor change, index falls artificially. So adjust divisor to keep your index stable, right? The rule here is that divisor ensures continuity, not exactly economics, right? So simple idea here is that let's say stock is 100 and stock A is 100, C is let's say $1, a both double. A impact is huge and C impact is negligible, right? So price weighted index is biased towards a nominal price, not your value, right? So remember that part, right? So very, very important to understand. Okay. Then once we have done this price weighing, we are going into another question. Given the information for three stocks presented in the following figure, X, Y, and Z, 10, 20, 60, 20, 20, 15, 14, the price weighted index is just the sum of these 30 and the sum of these at 31st January. Hence, the price weighted 1 month return is minus 16.7. Example 2, as the market closed on day 1, stock A has price 10, stock B has 20, stock C has 90. The value price weighted index of these stocks 40 at the close of trading. If stock C splits 2 for 1, effective on day 2. What is the new denominator for the index? The effect of the split on the stock C in the absence of any change in the price end of day 1 would be to reduce 90 by 245. The index denominator will be adjusted, so the index value would remain at 40 if there were no changes in the stock price other than to adjust for the split. The new denominator D must satisfy 20 plus 10 plus 45 divided by D equals 40, so equals 1.875, right? So, what I'm trying to put across is that in your price weighing, right, what we do is that uh, it is price weighted index is biased towards a nominal price, not exactly value, and divisors ensures continuity, right? So the index denominator will be adjusted so that the index value would remain at 40, right? Which was at the closing of the trading, right? And again, this divisor value is 1.875 here, right? So keep that in mind very, very clearly. Okay. Then we go into your market cap weighting, right? Market cap weighting methodology here is this method applies weights on the total market value of each stock, current price multiplied by share outstanding. In the formula, the index is calculated by comparing the current total market value of all index stocks to the market value during a base period. Now, example is 80 million, in this particular case. So index value is total market value of index stock divided by base year total market value of index stock in the index base value. Index base value typically taken as 100. Let's take the S&P 500 index. The total market value of the index portfolio in December 31 and January 31 are this and this. The index value at the end of January is, so in total market value of index stocks divided by base year total market value of index stocks 95 by 80. Right. So total market value, base year, index base value. Right. The market capitalization index percentage is this 18.75. So now, since it is moving from 80 to 95, right, this tracks your actual wealth kind of creation, right? So that is what we need to understand when we try to distinguish between price and your market cap. Please understand in your price, stock A doubles, price weighted jumps a lot. Stock C double, it barely moved. 101 example we had taken. So in market cap, bigger company drives your index. So core understanding is that your price weighted, basically what drives your weight is price. Market cap, what drives your weight is size. Equal, it is uniformity, what drives the weight. Fundamental is the value metrics, right? So keep that in mind, right? Small things, but very, very vital for the exam, right? Then again, same example here. Consider three firms described in the following table. Compare the effect on the price weighted index and the market capitalization index. The stock A doubles in price and stock C doubles in price, which I told you. Assume the period shown in the base period for the market cap and that's value is 100, right? So you have A, B, and C, which is, a number of share outstanding 100, 1,000, and 20,000, 110, and 1. Capitalization is this. The price weighted index equals such and such, right? If stock A doubles in price to 200, the price weighted index is equal to this. Stock C doubles, right? So it is only this much, right? So see, it is 1 and 100, right? If stock A doubles in value, the index goes up to 3.3 point, while stock C doubles in value, the index only goes up to 0.33 point. Change in the value of the firm with the highest stock, right? Change in the value of the stock with the highest, what you say, highest stock price have a disproportionately large influence on the price weighted index, which we talked about. For a market capitalization weighted index, the base period market capitalization is 100,000 to 100, right? 100,000 to 10, and right 40,000, right? So the effect we are seeing, right, is more for the, if the doubling is happening, it is more for the price one, right? So same thing continued ahead. Here we had done for this also became, if doubles in price 200 and it is double in price 2, 125 and 150. So in the market capitalization weighted index, the stock returns on stock C have the greatest influence on the index return because stock C's market capitalization is larger than that of stock A and B. So size is what affects, right? Size is what affects your market cap. Okay. So that is what we have. Then we have equal weighing, right? An equal weighted index places the same weight on the return for each stock, regardless of price or company size. Formula: the return on calculate the simple arithmetic average of the returns of the individual stock. Initial index value 1 plus average percentage change in stock. Calculate the equal weighted index value for the three stocks described in the following table. Assume the index value is 131. Right. So what is happening here is you calculate the change in index, right? And again, right, you assuming the index value 131. So whatever you calculated, right? 25 minus 7 plus 18.4 divided by 3, 11.9, which comes here, and right, and we get 146.59. Okay, so equal weighing has been explained. Okay, then we get into the next part, which is practice question. Before we get into practice question, please understand equal weighing. You are effectively doing, you are selling your winners, buying your losers. That's a contrarian rebalancing kind of thing. Whenever you think of your what you say, a framework for this, right? Please ask what determines your weight. If the price determines your weight, it's price weighted. If shares into price determines your weight, market cap equal means equal. Fundamentals, fundamental. Price, the bias is arbitrary. Market cap, it is momentum bias. Equal, small cap bias, fundamental value bias, right? So there is a bias, right? So price weighted index are very simple but flawed. Market cap indices are realistic but momentum driven. Equal weight indexes are diversified but costly. Your fundamental indexes try to correct the valuation distortion, right? So remember that, right? Fundamental are fundamental, right? And equal weighing are kind of contrarian rebalancing, but it is selling your winner, buying your losers, right? So contrarian investing kind of rebalancing kind of thing, right? So now going to this question, your analyst gathers the following data. Now we are looking for return on the value weighted index, right? So again, if you're trying to get the return, so what we'll do, it is return is what? End market value divided by beginning market value minus 1, right? What is the beginning market value? First you multiply, right? 20 into 300, 15 into 300, 26 into 200, right? So once you multiply, you get 73,000, this whole thing, right? This is your beginning market value. Then we look at ending market value. We are looking at, okay, and same thing, 22 into 300, right? 48 into 300, 30 into 2000, right? You do it, you get 81,000, right? That thing, and basically your 81 divided by 73 minus 1 is equal to your 10.96, which is 11%, right? So this is approximately B. Right. The key idea here is market cap index is just track your total portfolio value change. No need to calculate your individual returns, right? So that's pretty straightforward, right? Then we get into your next part, question number 14. Analysts gather the following data for an equally weighted index. We have A, B, C. Again, see, when you are doing for equally weighted index, right, return is average of your return here is your average of your individual stock returns. You have to remember this thing, guys. Please understand whatever I am writing, you have to understand and follow it, right? So we are going from 20 to 22 in this part, right? So it is, what is, it's a 10% return, right? We are going from 50 to 48, right? It's minus 4% return, right? We are going from 26 to 30, which is your 15.38% return, right? Now, what will happen is, just do it, right? 10 minus 4 plus your 15.38 divided by 3 is 7.1. So answer is 7C, right? So equal weighted, ignore your shades completely. Don't bother about that. Very, very simple, right? So you have to remember these things, how each thing is done, guys. This is what the whole idea here is. Question number 15, which of the following index weighing method requires an adjustment to divisor after a stock split? Right, we understand that is your price weighted, right? Price weighted is affected by your price change, so needs your adjustment. Market cap, price goes down, share goes up, no chance changes. Fundamental, unaffected, right? So remember that only price weighted index needs your divisor adjustment, right? So remember that. Okay, this is done. Then we go to question number 16. If the price return of an equal weighted index exceeds that of a market capitalization weighted index comprised of the same security, the most likely capitalization is what? So the idea is that, see, what is important to understand is that equal weight, right? Equal weight kind of your outperforms, right? Equal weight outperforms. Why? Because see, if the price return for equal weight index exceeds that of a market cap index composed of same security, the most likely explanation is equal weight. There is a more exposure to your small cap, right? So equal weight, I told you, right? It's like it's a different thing. Equal weight is greater than market cap, right? If equal weight is doing better than your market cap or market weight, small caps must be doing better. Because market cap greater than equal weight means momentum. Large caps are doing better. Equal weight doing better than market cap is opposite, right? So equal weight had a hidden SMB factor, right? Your former French model, your small minus big factor exposure, right? Which will come ahead, right? So remember this point. So again, very interesting question. You have to remember this. Next question is a float adjusted market capitalization with index each of its constituent security by its price, and so float adjusted weights based on price and what? So weight is equal to price into your free float shares, right? So free float is basically shares available to public, right? Excluding your promoters, government, strategic holders, right? So answer is C. Shares available to investing public, right? C. Okay, this is what real world indices actually use, right? So Market cap return, total value change, equal weight return, average return, divisor adjustment, only your price weighted, equal, greater than market cap, small cap outperform, float adjusted, use your tradable shield. Right? So remember that point, right? So again, right, what we need to figure out here is that price weighted is equal to price bias, market cap is equal to size bias, right? Equal weight is small cap tilt, right? Float adjusted is kind of investable reality, right? So price weighted, price bias, market cap, size bias, momentum bias, equal weight, small cap tilt. We're looking at investable reality for the free float, right? Float adjusted. Okay. So this is done. Then we get into next question. Which of the following index weighing method is most likely subject to a value tilt? Value tilt is what? Value tilt is what? Fundamental investing, right? A value tilt means the index tend to give relatively more weight to stocks that look cheap on fundamental, such as earnings, your dividend, your cash flow, book value, etc. So it's not your equal weighing. Equal weighing has a small cap tilt. It's your fundamental weighing because here things are based on fundamental rather than your market prices. It naturally tends to overweigh stock with stronger value characteristic. Market cap weighing is generally for momentum or overvaluation bias, not a value tilt, right? So answer is B. For example, remember fundamental weighing is value tilt, equal weighing is small cap tilt, market cap weighing is momentum like tilt, which you need to remember. Okay. So keep that in mind, very, very clear, right? So fundamental weighing indexes tend to have a value tilt, right? This is one of the major distinguishing feature, right? Okay. Uh, all right. Mm, fundamental weighing index tend to have a value tilt. This is one of the major distinguishing features, right? So keep that in mind. Uses and types of indexes, right? Okay, fine. So the idea is that you are now entering six new areas or six new topics, right? We're talking about index rebalancing and reconstitution. We're talking about use of security market indices. We're talking about types of equity indexes, types of security market indexes, types of fixed income indexes, alternative investment indexes. So this module is about how your weights are formed and more about how indexes are maintained, how why we use them, what kind of indexes exist, right? So that is what we're trying to figure out. Okay. So going ahead, we look at this part, index rebalancing and construction. We look at your rebalancing. Again, rebalancing is very, very important. Rebalancing means adjusting your weights back to your target weights after the price move. Example, suppose equal weighted index started with 33.3%, right? After price changes, weight kind of drift. Then the index is rebalanced equal to your equal weights, right? So important points which are given the slide is that it's done periodically, often quarterly, maintained, mainly important for your equal weighted indices, price weighted and in-them market cap weighted indexes mostly self-adjust through your price movement and needed so portfolio returns keep matching index return, right? Uh, Simple idea is rebalancing is about same stock, new weights. Reconstitution, when we talk about index reconstitution, reconstitution means adding or deleting securities from the index, right? This happens when a stock no longer qualify, the company is delisted, bankruptcy happens, another eligible firm is added. So reconstitution is about you changing the members of the index, right? So price impacts of reconstitution, this is very practical and often tested conceptually. Added securities tend to rise because index fund must buy them. Deleted securities tend to fall because index must fund must sell them. Key difference is rebalancing, which adjusts your base, reconstitution, adjusts your constituent. This distinction is crucial to understand, right? So keep that in mind very, very clearly. Then we get into question number 9, right? Rebalancing an index is the process of periodically adjusting the constituents, right? Which of the option is correct? Securities ways to optimize investment performance. No, there is no investment performance. Index providers are not trying to actively maximize return here. They're trying to maintain the design of the index, right? Uh, Securities to maintain consistent with the target market. That is more like a reconstitution because that means changing which securities are included. That's not the aim also. Adjust securities weights to maintain consistency with your weighing method. This is exactly what rebalancing is. So we are looking at C, option C, right? So key idea is the question says weights, think rebalancing, member securities included, think your reconstitution, right? Very, very important. Rebalancing means you're adjusting the weights of the current constituents so they remain aligned with the your intended weighing scheme, right? Then we get into the next question, right? Question number 20. Which of the following index weighing method require the most frequent rebalancing? Again, out of price, equal and market capitalization weighting. Equal weighing gives stock the same target weight, but once your price start moving, some stocks go up more, some go down more. Weights stop being equal. So the index must be rebalanced frequently to bring weights back to equal compared to others, right? Your price weighted mostly changes automatically with the price. Market cap weighted automatically changes as market cap changes. Equal weighted does not kind of self correct, right? So the key idea here is that equal weighted index requires the most kind of maintenance, right? Remember that as price changes, because initially equal weights drift apart, so equal weight indices the most rebalancing, right? Then we have done this question also. Then we go to question number 21. So reconstitution of security market index reduces what? Right? Does it reduce the portfolio turnover? No, it doesn't reduce the portfolio turnover, right? Reconstitution usually increases turnover because securities are being added and removed, right? So need for rebalancing, right? Reducing need for rebalancing? No, again, no. Rebalancing is a separate process related to weights, not your constant replacement. Then look at the likelihood the index includes securities that are not representative of the target market. Yes, that is exactly the purpose of your reconstitution. So over time, some companies no longer fit the index rules. Reconstitution helps clean up the index, so it still represents the intended market, right? So reconstitution help you ensure the index remain representative of the target market by removing firms that no longer qualify and adding kind of firms quality, kind of adding firms that do and removing firms that no longer kind of qualify, right? So rebalancing, you have same securities, adjust your base, mainly important for equal weight index, reconstitution change security index, maintain representation of target market, can create price pressure on addition and deletion. Overall, the hack here is that rebalancing weights, reconstitution members, uh, just understand that, right? So again, moving on is the use of security market indexes. Uh, Reflection of market sentiment, right? Basically, indexes your thermometer of the market, right? Gives a quick snapshot of your investor confidence, overall market direction. Also used as a leading indicator, rising index, optimism, growth expectation, falling index, pessimism, slowdown. Real world intuition is when Nifty or S&P 500 goes up, media says markets are bullish, or may go down, media says markets are bearish. That's exactly one of the use. Then we have benchmark of manager performance, very important use. This is the number one exam favorite of exam also. Active managers are judged via versus the benchmark. Large cap fund compared to large cap index. Key condition is benchmark must match investment style, risk profile. You don't compose a small cap fund, or don't compare a small cap fund to a large cap index. Then it is a measure of market return and risk. Index is a proxy for an asset class used to estimate your expected return, your risk standard deviation, helps in asset allocation, portfolio construction. To think like a portfolio manager, instead of analyzing 500 stocks individually, use index, which represents your entire market, right? So, which is very, very important. Okay. Then once we've understood this, we go to the next part. One is the core uses here. Again, measure of your beta and risk adjusted return. Index is your market portfolio risk. CAPM used to calculate beta, systematic risk using performance metrics, Sharpe ratio, Jensen alpha. Critical distinction is that index kind of measure your systematic risk, market risk, not your unsystematic risk, which is diversified away. And look at the model portfolio for index fund. Index is blueprint, passive investing, has ETFs, index mutual fund. These funds replicate index composition, replicate index work. Big inside index is theory, ETF is implementation, which we need to understand, right? Then we have your practice question number 22, right? So security market index are used as what? Right, measures of investment returns, not precisely, right? So that is very, very important. So we were doing the security market indexes are used as, right? Security market index are used as what? Are they used as your measurement of investment returns? No, not precisely, because index shows your market return, not your individual investment return, right? So not the investment return. Are proxies to measure your unsystematic risk? Again, no. Unsystematic risk is diversified away, so not proxies for that. Proxies for specific asset class and asset allocation model, yes, right. This is it. Index is a proxy for asset class, very, very important. Right? Proxy for, right? Uh, then you go ahead. Uses of your market index do not include serving as a uses of market includes market indexes. Uses of market indexes do not include serving as a what? Measure of systematic risk. Wrong usage, right? Wrong usage. Right. Okay. So again, since the question is asking confusing, right? Do not include. So that's a wrong usage, right? Because index measure your systematic risk, not your systemic risk. Now, this is very confusing. What's the difference between systematic and systemic? Systematic is your market risk. Systematic is your market risk. Like CAPM. Systemic is equal to financial system collapse risk. Please understand, market index do not include serving as a systemic risk, right? That's a wrong usage. Index measures systematic. Systematic is okay. Systemic is not equal. Your basis for your new investment product, yes, ETFs and index funds. Uh, Benchmark for evaluating your portfolio performance, yes, right? So we are looking not. So A is answer. Very tricky question. Very tricky question. Systematic versus systemic is a big, big exam trap. It's a classic trick of the exam. Then we have your types of your equity indexes, right? So again, investor can use a variety of equity market indexes. You have broad market index, multi-market index with fundamental weighing. Broad market index covers almost entire market. Example is your Wilshire 5,000 covers 90% plus market value. Use of that is what is overall market doing. You look at multi-market index, which combine your multiple countries. Example, MSCI World, your emerging market uses global regional diversification. Then we have multi-market index with fundamental weighing. Here, countries are weighted by a GDP or fundamental, not just by a market cap. But it's important because it prevents countries with global markets getting overweight. Then we have sector indices. Example is banking, IT, pharma, uses sector market strategies, business cycle analysis, etc. Okay, it's very theoretical in nature. You can read it quickly. Okay, then we get into style indexes. Style index, when we look at very carefully, right? We look at your style index. Uh, Important here in style index is that uh, based on your size, large, mid, small cap, stylish, value versus growth, how classification works, P ratio, dividend yield. Important point is high turnover because companies move between the categories over time. Example is small cap becomes mid cap or index changes, etc. Right? We need to keep in mind that. Right? And look at your practice question number 24. Which of the following statements regarding sector indexes is most accurate? Right? So again, the idea here is if you look at statement one, right? A, track different economic sectors and cannot be aggregated to represent equivalent of a broad market index. It is wrong, right? Because sector indices can be combined to form a broad index. So it's wrong. Provides a means to determine whether an active investment manager is more successful at stock selection or sector allocation. Again, this gives you that idea. So that's okay. It's correct because we are able to find out did manager pick good stock or just choose the right sector. Apply the universally agreed upon sector classification system to identify the cost insecurities of specific economic sectors such as your consumer goods, energy, finance, healthcare. Not correct, wrong, right? Because different providers use different classification systems. So very, very important. Please understand when you use an index. Index is used for market sentiments, so benchmarking, your asset allocations, your beta, CAPM, passive investing type of index are broad market, which are whole market, multi-market, which are global, regional, sector, industry specific, style, size, value, growth. Please understand difference between systematic versus systemic, rebalancing versus reconstitution, benchmark must match your strategy, etc. Okay. Then we go ahead to the next question. Which of the following is an example of a style index, right? When you talk about your style index, index based on geography or your economic sector or your market cap, style index is how you invest, includes your size, large cap, mid cap, small cap, value versus growth, right? So it is not your geography, it is not your economic sector, it is your market cap, right? This is your style, size based classification. You have style is equal to your size plus your value or plus growth, right? Then again, keep in mind, right? So it's not geography, it's not economic sector, it's market cap. This is style, size-based classification, right? Then we go into next point, types of your security market indexes, right? Again, conceptual, but very, very kind of powerful, right? First, we look at your market cap weighing. Most common bigger companies have higher weight, right? Float adjustment, only tradable shares counted. For example, promoter holdings excluded. Why it is important? It gives realistic market representation. Then we have constituent variability, different providers, different stock. Example, MSCI versus FTSE, FTSE, different inclusion rules. Then we have weighing constituencies or consistency. Always check how available shares are defined. Same index name is not equal to same methodology, always. Then you have, these are number of constituents for Dow Jones, large US cap, Nikkei, large Japanese stock, topics, all stocks in the Tokyo Exchange, MSCI, stocks in 23 developed and 24 emerging market, S&P, global energy, stocks outside the US, Barclays, capital aggregate bond index, global investment grade bonds, market below investment grade bonds, FTSE, global real estate, HFRX, global hedge funds, HFRX, global hedge funds, Morningstar, US stocks, stocks 25 to 25, variable, etc. Variable, 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 variable. This is price weighted, this is modified price, market cap, market cap, market cap, market cap, market cap, market cap, asset weighted, equal weighted, right? All these things. Okay, remember that. Then we go to the next part. Next is the type of fixed income indexes. The core idea is these are much more complex than your equity indices because there is a huge diversity, bonds different maturity, your coupon, your credit rating, your embedded option, classification is a problem. Indexes can be built on your issuer, which can be government and corporate, your maturity, short or long, credit quality, triple or junk, inflation linked, the construction challenges are there. Massive universe, bonds keep maturing, replace leads to high turnover. There is illiquidity, right? Many bonds don't trade daily, so use matrix pricing, which is approximate, replication difficulties. Your ETFs struggle more versus equity by thousands of bond, illiquid, high transaction costs. Equity index is easy to replicate, bond index difficult and costly, right? So that's the type of thing which you have to understand. So once you have read the theory, quickly go to the question. Which of the following statement regarding fixed income indexes is most accurate, right? Liquidity issues make it difficult for investors to easily replicate fixed income index. That's correct, right? So that is there, right? Liquidity issues make it difficult for investors to easily replicate fixed income indices. Illiquid bonds hard to replicate. Rebalancing and reconstitution are the only source of turnover in fixed income indexes, right? Wrong. Turnover also from bond maturity and new issuance. Then you have fixed income indexes representing the same target market, hold similar numbers of bonds, right? Again, it is kind of wrong, right? Huge variation across provider, right? So that is what we are looking at. Okay, so is the answer. So that's what we get. Question number 27. An aggregate fixed income index is what? Your only corporate and ABS, your only governments can be subdivided. See, aggregate index is equal to your broad universe, right? Includes your government, corporate, and securitized. So comprises corporate and asset back narrow. Represents the market of government issued securities, narrow. Can be subdivided by market or economic sector to create more narrowly defined indexes, correct? Okay. See, the key idea here is what we need to understand is aggregate is equal to your whole bond market. And then they are broken down into segments, right? So remember that. Then we get into question number 28. Fixed income indexes are least likely constructed on the basis of what? Maturity, type of issuer, coupon frequency, right? So generally it is maturity, it is made least likely. So it is made, type of issuer it is made, coupon frequency, right? Coupon frequency not used, right? Coupon frequency can be annual, semi-annual, does not define your risk return meaningfully, right? So overall, what you need to understand is a style index where size or the market cap is the main play factor. Then you need to understand value versus growth, equity index construction, market cap weighted, code adjusted fixed income, classified by issuer, maturity, credit quality. Big difference from the exam perspective is that if you're looking for turnover, equity index has low turnover, bond index has high kind of maturity, at maturity, liquidity. Equity index is high, bond index is low, replication, equity index is easy, bond index is kind of difficult, right? Then we go into question number 29. In comparison to equity indices, the constant securities of fixed income indexes are more liquid, easy to price, drawn from a larger investment universe. It is drawn from a larger investment universe, right? Not, I told you, right? It's not more liquid, not easy to price, right? It's drawn from a larger investment universe, right? So remember that it's the difference between equity and fixed income, which I just told you, right? Has more issuance securities than the equity market, right? Then we go to your alternative investments, right? Alternative assets offer potential diversification benefit. Types of alternative assets: commodities, real estate, hedge fund. Commodity indices represent interaction commodities, grain, livestock, metals, energy. Thomson Reuters, core commodity, CRB index, etc. Weighing method provided use varied schemes, equal weighing, global production values or fixed weight, resulting in significantly different commodity exposure and characteristics. One index may have large exposure to energy prices, while another to agricultural products. Future versus actual indexes based on future contract prices, not spot prices. Return reflect fees, rate, future price changes, and roll leads. So returns differ from holding the physical commodity. Real estate indices constructed using appraisal-based returns, repeat property sales or REIT performance. REITs invest in properties or mortgage and issues ownership interest to investors, available to close in mutual fund. Real properties are illiquid, but REIT shares trade like common shares, offering good liquidity. Example index provided, FTSE International, kind of thing. So that is good. Then we move into hedge fund indexes, right? Hedge fund pool investors money into your non-traditional assets using your leverage and long short positions. Most indexes equally weight constituent fund return, right? Funds are largely unregulated and not required to report performance, so coverage varies across indexes, causing substantial performance differences between index. Reporting by successful funds are more likely to report. Poorly performing funds often stop reporting, creating upward bias in the index pattern, right? Okay, so that is what we have, right? Then you have commodity index values are based on your future contract prices, the market price of specific commodity, the average market price of basket of similar commodity. So we look at your C, right? Commodity index values are based on the average market price of a basket of similar commodities, right? Uh, Commodity index values are based not on their futures, not on the market value of specific commodity. This is the average market price of a basket of a similar commodities, right? So index will be based on basket, right? So sorry, not this one, right? So you're looking at not no, sorry, I got it mistaken right here. So remember this part. See, again, the confusion came from average market price, right? Please understand when we take commodity index value, right? Those are not on your average market price, right? They're not on, they are based on your futures, right? And there is a reason for that, right? So please understand very clearly. So this is, again, I missed out here. Please understand very clearly. So stupid mistake. These are based on your futures contract price. You see, index value, I thought the index value will be based on your average market price, right? No, index values are not based on average market price. They are based on future contract price, right? Remember that future contract prices. So of your one or more commodity, right? Future contracts on one or more commodity. Common confusion. Don't fall for this trap, right? Right. Don't fall for this trap. Okay. Question number 31. Which of the following statement is most accurate, right? Most accurate. Commodity index all share similar weighing method. No, right? Commodity index contains the same underlying commodities. No. Performance of commodity index can be quite different from that of the underlying commodity. Right? That is true, right? Because it's a combination, right? It's a combination, right? So the performance of commodity index can be quite different from that of underlying commodities because the index is consist of future contract on the commodity rather than the actual commodity, right? So 31 is C. Then we go to 32. Which of the following is not a real estate index category? Right? Appraisal index, yes, it's a real estate category. Initial sales index is not the category. B. Repeat sales index is not the category, right? Is a category, right? So answer is B, right? So not a real estate one is your uh, okay, initial sales index, right? So it's not real estate index category B, right? Your initial sales index, right? Okay. Then we go to question number 33. A unique feature of hedge fund indexes is that they are frequently equal weighted, right? Uh, no, is not frequently equal weighted. Hedge fund indexes we are talking about it cannot be equal weighted. Are determined by the constituent index, perfectly fine, right? Reflect the value of the private rather than public investment, no, right? It is determined by the constituents of the index, right? So that is the answer here. Again, you have to understand these properties, right? They are very important. This is the answer. Hedge fund is not required to report their performance to any party other than their investor. Therefore, each hedge fund decides to which database it will report its performance. That's for a hedge fund index, and still determine the index rather than the index provider determine the constituents, right? So that's why judging the hedge fund performance is very difficult, right? Question number 34. The returns of hedge fund indexes are most likely biased upward, right? Because they choose their own index, right? Right, which were given in the earlier one also, right? So remember that point. Okay, so voluntary performance reporting may lead to survivorship bias and poorer performing hedge funds and will be less likely to report their performance. Okay, so that is what we have. Um, all right, guys. With that, we have finished the chapter. Again, what is important to understand here in this chapter is that there's a lot of theoretical concept here, easy concepts, right? But there's a lot of stuff here, and most importantly, you have to remember small final things. So go back and do the theory, then attempt the questions. CFA Institute, the good thing is the questions are absolutely very important material for passing the exam, right? So do that, right? Go back, do the question, 34 questions, right? You have to do and understand it well, and don't get confused. I got confused in one of the questions. Don't fall for that. It was a stupid mistake, right? This one, question number 30. Please remember, commodity index values are not on the average market. See, index gives you an idea of average market price, right? But it's not that. And similarly, it is given of a basket of similar commodity. No, commodity index futures are based, commodity index values are based on future contracts on one or more commodities. Future contracts on one or more commodities, not the average market price, not the average market price, right? So it's a common confusion. Otherwise, you can go back and see the chapter, lengthy chapter, but the whole idea is that there is module 2, which has rebalancing, reconstitution, security market indexes, types of input indexes, security market indexes, uh, uses and types of fixed income indexes, alternative investment indexes. And then you go to the module 1 also, where you have all these different weights, right? You have to understand, okay? You have to understand different weights, which is your uh, index value and return calculation, index consistent, choices and issues, comparison of index weighting method, price weighting, market capitalization, equal weighting, etc. Okay, remember that. Okay. All right, guys, I'll stop here and thank you very much.